just like to talk about the affairs of our fund for the last year. There's the disclaimer, which you know that you're supposed to read, and I have to present to you. I hope we can take that as read on this occasion. Just to say, I think it's important to very briefly back up over what we're trying to do here, because reminding ourselves of what the general idea is, I think, is quite a good discipline. This is the same strategy as our main Fundsmith investment fund in terms of the three planks of it. Try to buy good companies, try not to overpay, try to do as little as possible thereafter. It's got differences, however. It's focused on what we think are attractive demographics and growing purchasing power of middle-class consumers as that class of consumers arise in the developing world. And the reason that we basically put this into this particular structure is we think that it's a fact that there is much lower liquidity and much higher volatility in shares that are listed in those markets. They're much smaller than the ones in our main fund, and the liquidity on the local markets is lower. And most of them have a dominant shareholder as well. Sometimes a multinational, sometimes a family, sometimes a conglomerate. So you have much more limited liquidity than we've got in our open-ended main fund. And as you've seen with other fund managers from time to time, the idea of getting limited liquidity things in an open-ended vehicle can only lead to a problem. Basically, that's why it's in a separate vehicle of this sort. As I touched upon earlier, the strategy is the same as the one that we employ on the main fund. Buy good companies, try not to overpay, do nothing. I'll just touch upon each of those and say a little bit about it to test where we are in relation to that. What do we mean by a good company? We think a good company has a combination of these factors, basically. It makes high returns on capital employed. I've talked about this ad nauseum, if any of you have ever listened to me about it, me present on this. The world's greatest investor for the last 50 years, Mr. Buffett, is someone who's waxed lyrical on the subject. It's a necessity in a business that it makes a high return on capital if it is actually to grow in value over time. But it also needs growth, the second part. It's no good having a high return without any growth. So if you've got a wonderful return on capital, but you can't grow the business, then there's no way to deploy the capital that you're generating. Equally, there's no point in having growth without a high return. Anyone can grow a business with very poor returns. I always say, if you set up in business to give pound notes away for 90p, you'll have a very fast-growing business on your hands. It's just that it won't make a very good return. That's the problem. So you need those two things in combination. We also think you need other things. Predictability. It's no good having a business which makes high returns and growth for periods, and then you don't know whether it will in the future, and then it might again. So things that are very hit and miss, things like the movie industry, the major construction project industry, people who are basically dependent upon single inventions, such as the biotechnology industry and so on, are very difficult to predict the outcome. They may be great for a period, and then they're not. And sustainability in the widest sense. We're looking at people who in particular can sustain those high returns and that high growth. Not just the usual box-ticking approach that people take to sustainability, but what is it our companies have got? Have they got powerful brands, control of distribution? Are they spending enough on product development and R&D and innovation and so on? So in the widest sense, we're looking for that. So those are the things that we seek to find in good companies. Looking at those first two that I touched upon, the two that are easiest to measure with number, which is the return on capital employed and the growth rate, there's a chart which looks at in those bars. The red bars are the bars for the return on capital employed and the 5-year compound annual growth rate in cash flows here for these companies. And the red bars are subsidiaries, locally incorporated and listed subsidiaries of major multinationals in the developed markets. And the grey bars are the parent companies. So these are the major multinational parent companies. So that would be British American Tobacco. That one is British American Tobacco Bangladesh. That's Colgate-Palmolive. That's Colgate-Palmolive India. And as you can see, in every case, the return on capital employed is very much higher than the parent company's return on capital employed. So we think these companies tick that box. They make much higher returns on capital employed. And you can see over here, they also have much, much higher growth rates. My calculation from that slide is that on average, the return on capital employed for the ones we got up on the slide there averages 60% on a weighted basis versus 18% for the parents. Now 18 is pretty good return on capital. 60 is a lot better. Okay, and in terms of growth rate, these are averaging a growth rate, if you took the average of those bars, of about 9%, so about where that one is, whereas the average for the parent companies is around about 4%. So that one there, which is BAT, is pretty typical. Is it? Yes, BAT on there, I think. Is pretty typical. These companies, on average, are definitely making much higher returns and growing an awful lot faster. Right? But that's a selection of companies out there. What about our portfolio? This is what we call look-through metrics. So this is if we take all the companies we actually own in the portfolio and we work out their returns and their growth rates, we can tell you what it aggregates from their weighting in the portfolio, and we can compare it with other things. So we can compare it with the index. So there's our portfolio there for the last 12 months. There's the Morgan Stanley Emerging Markets and Frontier Markets indices. We've taken out the financials because we never own any of those. And there's the main Fundsmith Equity Fund. As you can see, the return on capital employed on our funds companies in the last year was 46%. It was 15% on the index. It was 29%. This is a very high return on capital in our main funds. This is a different order of magnitude. As you can see, it's something like 3 times the rate of return on capital employed that you get on average in the index. Okay? Gross margin, the difference between the revenues and the cost of goods sold. Companies take in things, they take in ingredients and components and people's input to their business, and then they do stuff to them to make things or services that they provide for which they charge a higher price. That markup is what this gross margin is measuring. You can see our companies had a 50% gross margin, so they made, for every rupee of sales that they had 50 cents of gross margin on it. The index had 31. The gross margin's higher over here because one of the big differences between this and this is we do own some retail businesses like Walmex in Mexico in this one, and retailers always have a higher margin. They're higher turnover. They turn over their stock faster, which is where they manage to make an adequate profit from, if they're good at it, but they have lower gross margins. They're distributors. They don't have as big markups. If you take out all the selling, general and administrative expenses, you get down to the margin that people more commonly talk about, the operating margin. You can see 21% on ours, 18% on the index, 28% on here. Again, the big difference between that and that is we've got retailers in this particular fund. Cash conversion, not all profits arrive in cash. Our companies are converting just over 100% of their profits into cash last year, 106%. The basic way in which you're able to produce more cash than you produce profits is you pay people more slowly than you get paid. They have negative working capital in a number of cases. Whereas you can see the index is about 84% cash conversion and this is 95%. I would say taking these measures in the round, it's quite clear that we have higher return businesses with superior cash conversion than the index and even than the main Fundsmith Equity Fund. And then if you look at the growth rate, what's their cash flow growing at? You can see last year it grew at 12%, so it grew about a third faster than this, which is the index, and about a third faster than that, which is the growth rate. So looking at these two things that we think drive, in the end, the creation of value in a business, the return and the growth rate, we think we've got good companies. That's our theory on it. I'll come back to the valuation, which is on the bottom part in a moment. But yep, so point number one is invest in good companies. We think that's companies with high returns and growth rates. We think we've got a bunch of them, basically. Don't overpay. This is a slide which I think illustrates our main point here, which is valuation, which is what most people spend their entire time thinking about when they're talking about investment, is not as important as the companies being good. If you're a long-term investor, what the return the companies make is more important than the price that you buy and sell them at, basically. This is an illustration which is basically the S&P 500 index during the 20th century. And what it looks at, the reason it's got those particular dates, is the low point in valuation for the S&P was on the 1st of December 1917 when America entered World War I. Basically, it was on a price-earnings multiple, PE, of 5.3 times. And the reason I've constructed this example is imagine you were so clever that you managed to buy it on that day, and imagine you were doubly clever and obviously lived rather a long time, and you managed to buy it really well and sell it really well. So you sold it on its high point for valuation. So just like worrying about valuation of a company, I bought them cheap and I sold them expensive. You sold your S&P index that you bought on the 1st of May 1999 when it was on 34 times earning, when it was on a lunar trajectory during the dot-com bubble. Well done. Okay, your return, by the way, if you had done that, would have been 11.6% per annum. So that somewhat puts into context what a return on equities might be. This is the world's #1 index, the S&P 500. The annualized return was 11.6% per annum. Makes you realize, if you're an equity investor, what one might aim for in a nominal return over long periods of time. Now, we can break down in a calculation that the bit that came from our genius in buying it very cheap and selling it very expensively, and the bit that just came from the companies making a return on capital, retaining about half of their earnings and reinvesting, because that's the passive bit that happened. If you've got a calculator that will do IRRs, like the trusty Hewlett-Packard 12C, which is what I've got, which has been the industry standard since the early 1980s, if you were to put in the following calculation, minus 5.3 present value, 34 future value, however many years that is, 82 years, N for the number of periods, and then press I, it flashes for a few seconds while it does an iterative process, and it tells you what the IRR is. So what did you make from buying it on 5.3 and selling it on 34? You made 2.3% per annum. So all of that brilliance in timing made 2.3% per annum, which, deducting it from the 11.6% you made means that 9.3% came from the companies doing their stuff. I'm sure some of you are familiar with Pareto's principle. Pareto's principle is that 80% of the consequences come from 20% of the actions in life. We have an exact replica of Pareto's principle here. 80% of the returns on the S&P during this period, if you'd have invested very well and held on till it was very highly valued and sold brilliantly at the exact right day, 80% of the returns would have come from you doing nothing in between, from the companies just doing their thing. And that's what we're trying to capture here, you know. Having said that, we don't ignore valuation. I mean, having said it's not as important as owning good companies, it would be foolish to ignore it. So where are we on valuation? And I can tell you the free cash flow yield, which we think is the best measure of valuation we can find, it's the cash flows the company generates after paying for everything except the dividend distribution. That's our cash. That belongs to us. They can invest it in the business. They can pay it back to us. They can buy back shares, although in this area, very few people buy back shares actually in the emerging world, because they have great sources of growth to invest in. But they can do all of those things with our cash. If we take that cash that belongs to us in any reporting period and divide it by the market value, we get a free cash flow yield, just like a dividend yield on these things. You can see it's 3.5% on our companies out here. It's certainly more expensive than the index, which is on 5.3, and it's a bit more expensive than the free cash flow yield on our main portfolio. The question you've got to ask yourselves, and the question we ask ourselves pretty regularly, is, yes, we know they're more expensive, but more highly rated, but does that equal expensive? Because people think expensive equals highly rated. No. You can have things which are very lowly rated, which are not cheap, and things which are very highly rated, which are not expensive. And so it's really whether or not what you're paying for is more than adequately made up in the superior returns. Well, as I said to you, you basically have got something here where you're getting 3 times the return on capital employed versus the index, about another 20% cash generation than the index, and something like a third more growth than the index. And I would suggest that that kind of differential in valuation is more than made up for by that. There's not a precise science in this. You just have to think about whether or not you think that you can get there. I mean, another way of looking at the whole thing is to add these numbers together and see where you get to see where you get to. I think that valuation is higher than the index, but not expensive, bearing in mind the quality of what we own. Do nothing. The fund basically attempts to do nothing. We never manage to do nothing. We don't manage to do nothing on the main fund either, because things happened. There are incidents. Companies get taken over. There's changes of strategy and so on that occur that cause us to have to do things, sometimes involuntarily. The turnover on the fund has been steadily dropping. You can see last year it was down to 19%. And that compares with 13% on the main fund last year. So we're starting to head towards a ballpark in terms of turnover that I regard as acceptable in terms of this fund. It will probably always have a little bit higher than the main fund. We've got more companies in it for a start. We've got 40 companies in this fund versus 27 or 28 in the main fund. That means there's more incidents that occur in relation to the companies. We also have more macro events that affect us in this fund. So there's always, I think, likely to be a slightly higher turnover, but it's clearly heading in the right direction and getting into the right ballpark. Performance, which is obviously the key bit. When I was running Untitled Pre-Bond, the broking business, my COO, during the annual bonus sort of discussions that you have with people, after he'd known me for a few years, said to me, "Terry, can I just tell you something about these bonus discussions?" And I said, "Steph, fire away." And he said, you know, every year you call me in for my bonus discussion and you say, well, the company made the following profit versus the year before, the return on capital was this, the cash generation was that, you, Steph, did the following things, I think you did this well and that badly and so on. And so bringing all those things together and in consideration, I think your bonus should be this. He said, "I've never heard a word you said until you told me the number." He said, "All I've heard for the last several years is blah, 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 then a number." So I'm assuming none of you have paid the slightest bit of attention to anything until I got to this point, which is the performance. And if you're anything like Mr. Duckworth, who learned after a few years with me that he could just tell me how it was, you know, and that was didn't cause any harm. Last year we had a bad year in emerging markets in general. We had a 3% fall in NAV. We had a bigger fall in share price. The share price more or less matched the markets. Obviously, we significantly outperformed in terms of NAV. Clearly, both are important, but the one that's most directly in our control in terms of the actions we take is that one there. We can definitely affect the NAV by the actions we take as a manager. We cannot directly affect the share price. The share price will be determined in any period by the buying and selling propensity in the market and what traders do with the shares, not what we do with the shares. So clearly, the bit that we can control is that. If we take that as being the thing we control, I regard that as relatively satisfactory. And it is always, can only ever be relative. You can't basically completely buck the trend in the things that you invest in. And I would hope that the things that we invest in will have a performance characteristic where we will do our best relative work in bad times, because what we own should be defensive. We're talking about people brushing their teeth, eating and drinking and going and getting medical tests. We're not talking about big discretionary purchases here, right? It should be defensive. Taking the longer term, at the moment, I would say we are still in a situation, and I think this is unarguable, where we have not delivered what we set out to deliver. Our staying with the NAV has compounded at 4.6% per annum since inception. The index has compounded at 7.1% per annum. We are lagging it by about 2.5% per annum. That is not what I think you expected or we expected to deliver at this point, and falls some way below the high standards that we try to set ourselves and that you should rightly hold us to. I think we can still make up for that, however. I think that given a bit more time and a few events, we will probably get to the point where a 2.5% per annum lag can be more than made up for. You've heard me before wax lyrical about the ketchup bottle, which is performance does not arrive regularly in almost anything. There are 250 working days in the average year, and when markets go up at 25% per annum, which occasionally they don't go up at 0.1% per day. It all arrives in 1 month, bang, that's it. It's like the ketchup coming out of the bottle suddenly. It's the same with this. My guess would be if we are ever to make this performance deficit up, which we've accumulated so far, it will happen very suddenly, like it did in December last year. If you looked at our performance last year, 10% arrived in 1 month. And the nature of performance is very much like that in my experience in investing. It's doubly so when you're investing in things which are a bit more illiquid and volatile. It just all tends to arrive very suddenly. It doesn't arrive very gradually over time. Why have things been like that? Well, I think our difference from the index, one of the great quarrels with the fund management industry in general, and it's a good one in recent times, is that the average fund manager underperforms the index. And the reason they underperform the index is they more or less buy the index and then charge you for it. This is not likely to have a great outcome, obviously. Now, in our particular case, we certainly can't be accused of that. Right? We can be accused of many things, and I'm hoping that we did a milkshake check to make sure none of you are armed before you came in here today. But whatever our faults might be, we're not running an index fund here, okay? We differ very markedly from the index. So you can see, we had, at the end of last year, 43% in the Indian market. The Indian market is 9% of the index. We had 15.9% in China, if you include Hong Kong. That is about half what's in the index. We had nothing whatsoever in South Korea and Taiwan, two of the other very big index constituents. We are taking a view here. Rightly or wrongly, we are differing from the index in what we do. Now, whilst I would obviously try and make a merit of that to you, and I think active managers should do different things from the index. The late Sir John Templeton, who was a great investor, said if you want a different result, you have to do things differently to people. Right? And we're certainly getting a different result at the moment, just not the right side of the line. And there's a reason for that, and that's it. And you've seen this chart from me before. I call it the jaws of death. And the jaws of death is basically looking at the period for the last half dozen years here, and it's looking at fund flows into emerging markets since 2012. And you can see there are two lines. Zero is obviously no flows at all. The grey line that's flowing upwards and now just appears to be about to go vertical like that is ETF flows. So flows that are going into emerging markets via exchange-traded funds, basically exchange-traded index funds. That's where more than 100% of the money has come from during this period. You can see active funds, whilst they held up well for a period, have basically had net outflows during this period. Most active funds have had money coming out and it's being recycled into emerging markets through the vehicle of ETFs. And there's the cumulative picture on the right, which obviously if you take the cumulative picture you get something very similar to that. This matters a lot because not only do we not own the country domicile of our stocks in parallel with the index, neither do we own any of the top 10 companies in the index. So there's the top 10 companies in the index. As you can see, they are a combination of the major Chinese e-commerce companies, Taiwanese or Korean semiconductor or consumer electronics manufacturers, Chinese banks, Chinese mobiles, more Chinese banks, Chinese insurance, etc. There's our top 10 over there. We are both more concentrated, 40% of our fund is in there, and it's only 23% of the index over there, but none of those are companies that have passed muster for us. And yes, we have done a lot of research and tire kicking on these, and who knows, maybe that will change in due course. It's possible. I think that there may be one or two on there that could get over the line for us in due course, which frankly would be a fairly happy status for us because it would help to close off a bit of this risk of what happens in us differing from the index, but it hasn't happened so far, and I'm wary of making a decision where we just go, well, look, the problem is money's going into the index via ETFs. That keeps going up. We haven't got any of them. It's very painful. Why don't we just go and buy a couple of those shares? Because if you went back and you looked over the last 15 to 20 years at that list, you would see that it's changed quite markedly. If you take the decision about 20 years ago to go, it's too painful trying to do this by investing in good companies because I keep underperforming the index when money's flowing into the index because it goes into the big companies. I'll just go and buy the top 10 companies in the index or the index itself. You would have been buying things like Gazprom, right? Buying things that you really don't like and don't want to own just because they're bigger in the index doesn't generally have a happy ending, in my view. Right? Because you would have found that the commodity companies, in particular the Russian-dominated commodity companies, were a very large part of the index during that period. So we're not ever going to go and buy these things simply to try and stop the problem of differentiating from the index. We'll only buy them if we really think that they fit what we're trying to do. Okay. In terms of the fundamentals of the company, and it's a very simple, obviously I'm only putting one number up here because we don't want to have numbers all over the place because Martin will get confused by them. The return on capital employed on our top 10 companies are there. You can see it averages 43%, quite close to our average number, unsurprisingly, given that they're 40% of the fund. The average on this lot is 13%. There are a couple in there which are quite decent. Tencent is quite decent, Taiwan Semiconductor, Samsung. They move about a bit, though, and you've got to worry a bit about the longevity of some of those. Because remember, when we're talking about sustainability, I worry about the sustainability of a company which is basically the Chinese closest equivalent of Facebook, but which has a major business in online gaming, which is regulated by the Chinese government. I mean, you are basically in partnership with the Chinese government in this business. It worries me. What worked and what didn't work in the last year, you can see there are our top 5 best performing companies in terms of their contribution to our fund. There's the bottom 5. Our best performer was Vitasoy, which is a Hong Kong-based soy drinks product business, which I think is one of the best businesses that I've ever seen in the area. As you can see, we have an Indian representation, unsurprisingly, in Nestle and Hindustan Lever in there. We have a Chinese company in Foshan Haitan, which is the biggest manufacturer of soy sauce in China, and Ceylon Tobacco, the Sri Lankan-based tobacco business. Bottom 5, there's only one Indian company in there, Amami, which was quite heavily exposed to the informal sector in India, so not the modern retail sector, which has been adversely affected by the reforms such as the GST and demonetisation. DP Eurasia is the Domino's Pizza master franchise for Turkey and Russia, which has obviously been affected by the Turkish crisis. We think it's a keeper, basically. If you look at its history, it's always gained market share and prospered during crises in Russia and Turkey. So we think it's a keeper. Vietnam Dairy, it's the leading dairy business in Vietnam. We were discussing it at the board meeting with the board this morning, where we were looking at the size of the Vietnamese population and how it's grown and the youth of the population. Fan Milk in Ghana, which is a dairy products business in Ghana, and Tiger Brands in South Africa. We have been adding to that one, and we've been adding to that one during the period when we've had relative weakness in them. In terms of currencies, you can see those are the major currencies that shown strength for us, relatively speaking, and have added to our performance in the last year. Those are the ones which have been problematic. I just pause with that one. We've got, as you can see, more than 40% of the year end in India. We've still got something close to that in terms of percentage in India. A thing that's affected our short-term performance quite significantly, particularly in the last 6 months, but also, as you can see, going back into last year, has been the political situation in India. I really wish, in some respects, this meeting was occurring tomorrow rather than today, for a very simple reason: we're going to get the Indian election result tomorrow. And it seems very likely that Narendra Modi's BJP will form the next government, that he will be back in power. But I think there's been an awful lot of disruption of the economy during the run-up to this election, that you can see that demand, particularly rural demand, has slumped during the period of the run-up to this election. That people who've got relatively little safety net in life, if they think there's going to be a change of government that might adversely affect them, stop spending in those circumstances. I think, as I say, all the exit polls and other indications are that Mr. Modi and his BJP will be back in power. For what it's worth, I think that's a good thing. I think he's a genuine reformer, and I think we've got the vast majority, vastly the biggest holding in our fund, exposed to really good companies there will benefit from that, and it will be good for us. But the reason I'd like to have this meeting tomorrow rather than today to look at that is looking at what happened in Australia. The only poll that really counts is the one where the people voted, not the one where people tell us what they think is going to happen. So I really would like to see the outcome of that before I go and celebrate. Would be my view. Since inception, just go back a little bit further, you can see those are the major companies which have contributed to us since inception. As you can see in this particular case, 1, 2, 3 of them are Indian companies. So longer term, our Indian exposure has definitely been good for us, and I think will be good for us again. And these are the ones which have been our major detractors since inception. In these particular cases, we're no longer in Magnit, which is the Russian supermarkets business, or Womp Womp, which is a Chinese business. In terms of currencies, India, it's been a real problem for us, really sapped our performance in the last 6 months, both in terms of the company share prices and the double whammy of the currency. But longer term, it's been a good place to be, you can see, whereas these have been the relative detractors during that period. Martin mentioned the change in the way that we're going to be managing things from the end of this month, and I thought I should say something about that. What's happening is I'm going to continue as CIO, Chief Investment Officer for FEET, and Michael and Sandeep are going to step up and be Portfolio Manager and Deputy Portfolio Manager for us. It's not coincidentally exactly the same structure that we adopted for the Smithson Investment Trust that we launched last year, and really we're taking a lesson from that in terms of, I think, the best way for you to get what I've got to give to this out of it, which is everyone has got a limit to their span of focus that they've got, including me. And I think I'm best when I focus on the bigger things rather than the day-to-day dealing type things out there. And I think the Smithson thing, no doubt due to more than one factor, I'm absolutely certain it is a much better structure where I've got 2 portfolio managers who I know will be spending the time from when East Asia opens till Latin America closes, looking at anything that they need to do in terms of dealing, rather than me, and that I spend my time thinking about whether there are any outright buys or sells that we need to do, or any moves that we need to make in terms of sector and so on. And I think that's demonstrably worked a lot better at the Smithson one than this one's worked so far. And I think that's one of the factors that I would put in there and why we haven't performed as well as I think you've got a right to expect and we want to on this particular trust. So that's why we're making that change. I'm not running away from this or backing off from this. I'm still going to be the CIO. I'm still going to be discussing all of the outright buys and sells with the guys before they make any. I will still stick my oar in and say things if I think there's something to be said. They will be able to ask me if there's something they want to ask. I can bring things from my breadth of view when I'm released from minute-by-minute decisions to help. Let me give you a live example of that. One of the holdings in FEET is TravelSky, the Chinese airline reservation systems company. One of the holdings in the Fundsmith Equity Fund is Amadeus, the European-based airline reservation systems company. One of the holdings in Smithson is Sabre, the American airline leading reservations company. I can, when I've got time to focus on it, help people with what's happening with the trends in the industry, whether airlines are attracting people to go direct rather than use the reservation system, what they're managing to charge, who's gaining and who's losing market share. So I can actually bring something, I think, to help all of the parties concerned, but I'm best at doing that when I'm not sitting there looking at a screen. Looking at the screen is almost the last thing you want me to do. I'm no better at looking at the screen than anybody else in this world, basically. Probably worse than most, actually. So, that's what I will be doing from this point. We reduced the fee. We went to the board and said we think we should change the structure to basically go to the same basis as the Smithson Investment Trust. David, who is the member of the board who engages with us, quite rightly said, well, perhaps we might have the same fee then in those circumstances. And it's a fair proposition because I'm the most expensive resource in our business, and therefore I think we should reflect that. So we're taking down the fee. As Martin said, this is a relatively expensive product to run. In terms of the cost, which hopefully over time will be spread more and more over a bigger fund. But I can tell you in terms of our travel bill, a small clue is that our travel agent, until she realised it gave entirely the wrong impression, when we opened this fund, started sending us all bottles of champagne at Christmas, until she realised what we knew that indicated. But it does have a fairly large overhead associated with it. Not that I expect you all to be terribly sympathetic, I'm just telling you the fact.